Coast, unfortunately, but hopefully soon it will be. So how you doing?
Doing well.
Welcome.
Thank God.
Thanks
Thank
for
you for
doing
having me.
this. So
Yeah,
we wanted to start out with just an overview of the capital markets and what you're seeing so far. Um, you know, in the MHP space and beyond with as it relates to rates and where you see they maybe going over the course of the next quarter. And then, just open it up to a Q&A for everyone. I'm sure there's a lot of questions as it relates to financing in MHPs, whether those are kind of beginner questions or more advanced. I know, there were a couple individuals who had some questions about seller seconds today on our group call, and some of those individuals are on now as well. So they may have some questions for you about how to structure that and when to communicate that to the bank that you're financing alongside, the seller second. So I'll hand it off to you to kind of jump into the broad overview and just talk to us about what's going on in the capital markets, what we might be able to expect in the future.
sure. So firstly, appreciate you having me on. It's always a pleasure chatting with you and being able to share some tidbits with others. Um, as far as the capital markets today, just as a heads up, my head is not fully in this game yet. It will get there. I just had a pretty crazy day. I don't know if you've been monitoring rates, but my kids were asking me when the next time I go to an amusement park is. I said they could just come to my office and watch the Treasury bond. It's been a wild roller coaster of just, we had a drop of 40, 50 basis points, and now went skyrocketing, back up, all due to the tariffs, obviously, and market uncertainty. So, you know, when people ask me where are rates, like I have a loan that we're attempting to rate lock still, it's 5.11 here, and treasuries are officially closed, but we're still trying to get this deal closed. Um, and it's a pretty large loan. Just to give you a little bit of an inkling of what's going on in the market, around a week ago, my loan was sizing for 37 million, and today it's sizing for 35. And that's
Wow.
purely due to both the treasury bonds going up and the subsequent spreads that lenders use, which we'll get into, above treasuries. The spreads have blown out because investors are just not confident in the market. And then you have the treasuries themselves went up. So when you have a loan that's, commercial loans are always measured by two aspects, which is LTV and debt service coverage. The LTV on this deal is not an issue. We have the value of the property is over $58 million. But where you run into an issue is on debt service based on cash flow. So that's obviously ties directly into rates, and depending on what your property can support, what mortgage could support based on in-place cash flow. But that obviously ties into rates. If your rate was 3%, then you can easily support a larger loan. If your rate is 7%, you can't support such a large loan. So that's just what's going on here today. As far as the actual debt markets for MH, it's been surprisingly strong. And when I say surprisingly, it's because, the sentiment out there is that the real estate market is struggling and there's not a lot of deals, which is kind of true. We all experience that. We know that, the deal flow is down, and um, sellers are still asking for some unrealistic numbers on some deals. But on the other side of the table, on the lender side of the table, there are definitely, I would say, an influx of lenders that have entered into this space, or whether they might have been in the space and put a pause and now are back, saying, hey, we want to put out money, we want to put out money aggressively, send us your deals, let's get the deals done. So that's the overall, I would say, high level view of the holistic view of the market in general. However, there's such a wide spectrum of lenders. So depending on what type of deal and depending on where it is geographically, the nature of the park-owned homes, tenant-owned homes, occupancy, all those factor into which lenders are going to take a real interest in the deal. And then that can make a tremendous difference in your kind of loan that you're going to get, whether it's an agency loan that they like all the nice parks and they'll be the most aggressive and give you IO and give you great rates, to smaller regional or even local banks that can lend on things that are not as nice or not as clean or have a story or there's a value add play, but not necessarily will they be as aggressive on your rate or as aggressive on your loan terms per se. So that's kind of the holistic view of where things are at within the lending space. But there are definitely a lot more options today than I would have been able to tell you even 6 months ago. With a lot of the lenders that are poking their head back out of their shell and saying, hey, what's out there? What kind of opportunities can you show us that we might be able to make a deal on?
Great. And so do you think that those are lenders who previously left the MHP space and are now coming back to it, or new lenders in the space who are kind of coming around to MHPs?
I would say it's a combination of both. But I would say more so with lenders that have lent on the space, maybe in years prior or maybe in months prior, that kind of put a pause, and then now they are back in it looking to put out money on it.
Great. And then one question we get pretty often at the MHP Pros is, what about POH? And I guess, how do we think about that as investors when we're looking at parks that maybe they're not majority POH, but like, are we going to be able to utilize that in our DSCR calculations, or not? And does that tend to be like only a few banks or lenders that are going to lend on POH, or is it now that the market's coming around to lending in general on POH revenue?
Right. So there's two parts really to that when you have a park with park-owned homes. There's the general question of lenders that are not comfortable with the fact that there are even a certain percentage of park-owned homes at a park. Even lenders that will only count lot rents, which is the majority of lenders. There are very, very few banks. Sometimes a local bank can get comfortable counting the park-owned home revenues. And then you have one or two national banks that are able to count those home revenues and take the home as collateral. But even when you're going with lenders that, okay, we're not counting the cash flow from the homes, we're not counting the rents coming in for the homes. But then there's another conversation that takes place if you have a park with too many, in their minds, too many park-owned homes, then it's a park that they don't want to lend them at all. So that starts from the cream of the crop in MH lending, which is Fannie and Freddie. They would be, the best lenders out there as far as rates and as far as everything else, non-recourse, but they have a typical 25, sometimes it's 30% park-owned home cutoff. So if you have more than 30% park-owned homes in your park, they won't lend on that park. What their reasonings are is basically they feel like a park with park-owned homes doesn't have that stickiness with tenancy. So if there's a certain percentage over over 25, 30%, they don't want to lend on that park, period. So there are other lenders that follow suit, whether it's some of the large national banks, some of them that have a Fannie and Freddie DUS license, so they kind of follow that same metric even for their balance sheet lending. And even some of the larger national credit unions have their cutoffs. CMBS, which is another popular vehicle to get parks financed, has a higher benchmark, probably closer to 50%. But if you have a park that's 55, 60%, or especially if it's 100% park-owned homes, they're not going to want to do that deal. And then, we have some lenders, or I wouldn't say some, a nice amount, and that kind of ties into your question of now that there are more players in the space and more banks that are coming out and saying that they want to lend on the space, you're going to have more options of banks that are comfortable with a lot of park-owned homes or even 100% park-owned homes. But that doesn't translate into more lenders that are going to count the park-owned home revenue, at least not yet. We can always dream. But As of now, I would say, again, you might have some local banks that can get comfortable with that, and you have the one or two outliers that actually do take the home revenue, but then, they take the homes as collateral, they're counting the home value. You can't then sell off homes to tenants. So if your game plan is going to be, let me go into a park, has all park-owned homes or majority park-owned homes, I'm going to start selling off those homes, then obviously a lender that's taking the homes as collateral and counting on that income can allow you to do that because now their revenue is going down. So, I'm happy to explore both options. So when a client will send me a deal that is majority park-owned homes, and they're like, well, this deal only really works with park-owned home revenue, I'm happy to explore both, but what you'll find a lot of times is it's not that big of a delta between the loan amounts, given that when you take the park-owned home income, you also have to count all the park-owned home expenses. So your NOI is not, some vast difference. And then your rates typically on those lenders that will take the park-owned home revenue are a lot higher, sometimes close to 2% higher on your rate. So if rates today are in the sixes, those banks are going to be in the eights on your all-in rate.
That makes sense. And I've worked with you and your team, Judah. You guys are fantastic. So a question that I would have had and now don't have to ask, but I'll ask for the sake of this group is, are you going to help us determine what is an expense related to POH versus an expense related to TOH if we do decide to do a loan like that?
Yeah.
Awesome. Yeah. And just for everyone's edification, Judah and his team do kind of put together this package for the banks, and that's what makes it so easy to work with him. And that's why he's able to get us so many options, because different banks want different things, and he knows that very thoroughly. So, just a plug for you there, Judah. He's very knowledgeable, but he also makes the process super easy.
I hope.
Yeah, exactly.
Yeah, that's our goal.
Wanted to let other people jump in here with questions. I know Mike Fitz had a question, and I don't know if he's available to talk right now, but I'll bring him to the stage so he can ask it himself. Hey, Mike, you got time, or can you answer that or ask that question live for us?
Yeah, totally. I'm driving back right now, so I was just kind of popping in.
Hey, Mike.
Okay, yeah. So my question, can you hear me?
Yep.
Yeah.
Okay, perfect. So the question I had was, as I'm looking at this one park that I'm getting financed with a bank, I've got the bank commitment and I've got the seller committed to hold back a portion. When you're talking to these banks, do you need to be 100% kind of forthright and bring that to the table that the seller is going to stay in with like a second lien on some of it, or will that be like a deal breaker for some of the banks?
Great question. So the short answer is always be upfront with the lenders about it, about everything that is consequential to the loan, structure. So even if you have banks that are comfortable with it, I would bring it up and let them know about it up front. But this is something that, whether it's not necessarily official fraud, but I would say definitely falls into that gray area where if you're trying to build a relationship with a lender, you don't want to have them find out like, oh, we gave you a loan and we didn't know about this seller second. Like, you should have told us. Whether or not they care or don't care, it's something that is just strongly recommended to just be completely upfront with lenders. And especially because, yes, there are some lenders that do not allow for seller seconds, period. They don't want someone else behind them, such as Fannie, Freddie. Some of the larger banks are typically the ones that just don't want any sort of seller second behind them. And the other banks that do allow for it, so then you have kind of a mixed bag there. You have some banks that allow for it and don't really care what it is. Some of them might not even care if you're coming with any equity to the table, or maybe very minimal equity to the table, because they understand the seller second. And they're totally cool with it. That's typically like the smaller regional, smaller local banks. Sometimes when you get into the other kind of bucket, regional banks, larger national banks, they can be cool with the seller second, but a lot of them will have to use that as part of their underwriting. So if you're going to look at an NOI of a property of $100,000, and therefore you're saying, well, $100,000 supports a loan today of 1.3, and I'm I'm buying this park for 2 million. I'll take 1.3 from the bank and take 600 grand from the seller and make a deal happen. The problem is your NOI is not really $100,000 because $100,000 is before calculating your seller second payments. So if they are, and they will have to be, the seller second will have to be in second position to the lenders. So the lenders look at it, okay, if you're in second position to me, that means you need to get paid, and we need to get paid. So we never want to be in a position where you're not making your bank payments because you also have the seller payments to make. So what happens is they have to calculate that into their cash flow analysis, which will then sometimes typically will bring your loan amount down on the senior bank side. So it is a way of creative structuring a deal where you might not be getting the best LTV out of a bank, but keep in mind that if you're going to go with a lender that is kind of more sophisticated, we would say, a larger bank, and they need to know what those payments are like in order to calculate that into their cash flow, it can be it can then hurt your senior loan to bring down that senior loan slightly. So there might be some middle balance where it all makes sense, but it's not as simple as just, okay, I'll get 70% from the bank, 20% from the seller financing, and I just put on 10%.
Yeah, that makes a ton of sense. Okay.
Any follow-up question there, Mike?
No, I really appreciate you sharing all that, Judah. That was exactly what I was looking for. I guess I do have another question, somewhat related, somewhat unrelated. So, a portfolio of parks I went to go look at today. There's like a third of them, a third of the homes are park owned, and they're actually really nice homes. I guess the seller was a retailer, so they're all like within, a few years old, and he's looking at having the value of those homes translate into the purchase price, which I can't really figure out. But he did say that he would be open to, I guess, seller financing me the homes if I could come in with the bank for the full purchase of everything, not including the homes. And then he would do kind of like a seller finance of all 30 of the homes together onto one note. Is that,
Yeah,
how
that's
I
actually
guess, how would that work? Or
yeah, that's actually an interesting question because we've seen that. So just to throw out numbers, for an example, if you're buying a park for $5 million, but there's 50 park-owned homes. So in essence, we always try to say, oh, I'm not really paying much for the homes. I'm paying, I'm allocating very little towards the homes. I'm paying mostly for the land, and the homes is just gravy on top. But if you can kind of work backwards, where if I analyze a deal based on just lot rents and just lot NOI, and I tell you that based on this, your loan is going to be $3 million. So then what you can kind of reverse engineer and take that and say, okay, $3 million divided by 70% or 75% is what? And then whatever's remaining, let me allocate that towards the homes. So now I know I'm getting my 75% LTV on the land itself, and anything above that is allocated towards homes, and on that the seller's financing 100%. So that allows the bank to be comfortable because they're not taking the homes as collateral, assuming that we're going with a typical bank that doesn't take the homes as collateral, and therefore don't have a seller second in second position to them. The seller second is secured by the homes, and the seller second is getting paid from the cash flow that's coming in for the homes, and not for the park. So that would be the easiest way to structure that.
okay. Yeah, that's perfect. Okay. I had never even thought about that. He kind of brought it up, and then we were just kind of workshopping it a bit, but it's kind of perfect timing that, to ask that question here. So thank you.
Sure.
I guess this would be unrelated to that whole piece of it, but, and maybe this isn't a question for this conversation, but how would I necessarily value the homes? I mean, if he sent me like a list of the years and the sizes, is there like I guess somewhere where I could come up with like a fair market value? Or
yeah, that Michael might be able to answer better than I can, but I would assume there's like some blue book value, similar to cars, where you can look up what typically those homes should cost.
Okay, perfect. All right,
Yeah,
thank you guys.
Mike, it'll be based on year, condition, etc. But you can actually get appraisals for these homes specifically. There are companies that do that, and I can send you those details after the call. So thanks for the questions,
Okay,
man.
okay, perfect. Yes, thank you guys.
All right, and then Saeed had a follow-up question I'll just ask on his behalf. The answer to the question that you just gave, he said that's assuming they do loans on parks with majority park-owned homes, correct?
Correct.
Yeah. Okay. All right, I'll bring Pat to the stage. I don't know if you want to ask this live, Pat. I can ask it for you if you're not able to speak.
Can you hear me?
Yeah, I can hear you just fine. Go ahead.
Awesome. Hello, how you doing, guys? Real
Okay.
quick question. I know this is very generic, but when I'm underwriting things currently, I'm looking in the Midwest, looking at parks from like 20 up to maybe 80 pads. What would be a rule of thumb, or let's say in today's market, would be a good interest rate to use? I'm using 7.5 with a 25-year AM just to see if I can get close to the seller's number, which I have never done that. So I'm just trying to figure out, am I too high on the interest rate, or am I, and I know there's a lot of factors. I get that.
Yeah, I would say as a kind of conservative, you don't want to go too aggressive and then win a deal with something that turned out to be too aggressive of an underwriting. So the same way, I'm sure Michael tells all the mentees here, when you're underwriting a deal, even if you might be able to run operations here with a lower payroll and with lower repairs and everything else, but kind of run your numbers more conservatively to make sure that this deal really works for you. It's going to be the same thing with interest rates. So I would say on the conservative side, probably 75, probably 7.5 on a 25-year AM is definitely more conservative. I would say you can even use a 30-year AM.
Okay, thank you.
Sure.
Hey, can you guys hear me?
Hey, Saeed. Sorry, I was going to ask Pat if you had any follow-ups. So I was on mute. Pat, are you all good?
I'm all set.
All right, man. I'm going to move you off the stage. Saeed, go ahead.
I got two questions for you. Also, thanks for taking the time. First question is, you're saying new lenders are kind of, sounds like they're coming in the market, more interest, becoming more competitive. Are you seeing people move towards financing on smaller parks, say below 500,000? I know that's kind of usually the benchmark, and specifically even on refis versus acquisitions.
Sure.
Um, yeah.
I've not seen that yet, but to be completely transparent, it might be happening and just I'm not aware of it. And what I mean by that is, I, in my role here, I have a tough enough time keeping up relationships with all the regional banks and national banks and even some of the smaller regional banks. So I don't have the capacity and bandwidth to really keep up relationships with some of the smaller banks or really small regional banks. But I would imagine that the same way I'm seeing on a more national level and on a more larger bank level, some renewed peaked interest in the space, I would imagine that applies also to the smaller banks that are typically the banks that are doing loans, I would say below $1 million. So on loans below $1 million, you're usually, and I guess there are always exceptions, and especially once you build a relationship with even a national large lender, they'll make exceptions and do all your small loans too. But typically, the larger banks are looking at $1 million and above, and for below that is when you're going out to local banks. So to answer the question, I would imagine that it might be happening the same there, but I wouldn't know.
Okay. No, that's helpful. And for my second question, and this kind of stems from I'm working possibly with a lender. I'm evaluating whether to sell or refinance a community of mine right now.
Mhm.
But any tips on when you're trying to kind of like proactively estimate what it will appraise for? Two ways I think about it is looking at NOI and trying to figure out the cap rate or an area for that area, or specific otherwise just kind of not, I wouldn't say back into the 125 DSCR, but just at least make sure it covers at that value, and that can kind of give you a rough where you think it might appraise.
Yeah.
But yeah.
So it's tough for me to opine because it's so, like you can imagine, it depends on the market, depends on rural, suburban areas, depend on size of the park, private utilities, public. I think there are too many factors that go into MH to properly tell you what cap rate is applicable without knowing more about the park. We see cap rates range from people still paying 3.5 caps for gorgeous, 50 plus communities, 5-star parks in Florida, all the way out to, 11 and 12 caps for really rural, smaller parks on private utilities with, gravel roads out in the middle of Wisconsin. So there's too many factors that go into that to tell you what you would use. But I would say, other than reaching out to some of the appraisal companies out there, such as Collier's, they're pretty receptive to, at least without you spending too much time or money, to be able to just tell them, hey, this is the basic rundown of my park. There's the amount of pads, it has paved roads, it's in this and this town. What applicable cap rate? Because that is obviously and honestly the best way to value it. To back into the debt service coverage, again, it's not really going to help you because there are plenty of deals that debt cover all day if they're not cap rate constrained.
Okay. That's helpful. Thank you.
Sure.
All right, we got Eric with a question here. Let me bring Eric forward. It doesn't look like he can talk, but if you can, Eric, just let me know. I'm going to ask the question on your behalf. Hey, Judah, thanks for doing this. Can't talk, but maybe someone can read my questions. If the seller carries a note collateralized only by the park-owned homes, will a bank look at that differently than a true seller second? How can we get agency? Is this a separate question? Yeah, it looks like it is. So I'll just read that again for you, Judah. If the seller carries a note collateralized only by the park-owned homes, will a bank look at that differently than a true seller second?
Yes, because the true seller second, they look at it that it's backed by the park, and therefore two things. Firstly, they have someone in true second position to them on the same asset and on the same collateral. And then B, what we discussed earlier, which was from a cash flow perspective, if they assume that the park is paying for the seller second, then they have to calculate that into their cash flow analysis, as opposed to if it's coming out of the park-owned homes, then we can assume that the park-owned home rents are paying for that seller second, which then a bank that's only looking at a park's cash flow and not including the home's cash flow doesn't have to include that into their cash flow analysis.
All right. No, this doesn't sound like a follow-up question there. So the second question is, how can we get agency or CMBS debt on multiple parks near each other, especially multiple smaller parks that add up to 50 plus lots? How close do they have to be together?
Okay. That's an ever-changing stance on the agency side. I can tell you where they stand today, and I'll tell you what we've gotten done in the past, and maybe what we'll be able to get done again in the future. Their stance today is that they want to see one large anchor park. And then when they say large, it's going to depend on how many other parks you're trying to tie together to it. So if, for example, you have a 75 lot park and then you want to tie into it 3 other 25 or 30 lot parks, that's what they'll look for. And as far as the distance between that anchor park and the smaller parks, right now their stance is that it has to be within the same state. So that's a pretty wide net. So if you own one large park in Ohio, and then you want to refinance that together with 15 other smaller parks, that can be done. But across state lines is what right now where they drew their line, and said that those parks won't be able to be looped into one large loan. But in the past, we have gotten done across state lines. We have gotten done even parks that we used to combine them to get over 50 pads. So you have some parks that are, call it, someone has a portfolio of 5 parks that each one are 42 pads. We were able to get those looked at as combined and get that done. But that was when the parks were within, I think, the same county. But now they're saying that they can't do that anymore. However, if you have 2 parks literally down the block from each other, so they might be separate parcels, they might be even officially separate parks, but if they're within a couple of blocks, even, I think the official guide is within 2 miles. So if you have 2 parks within 2 miles that are sub 50 pads each, sorry, you will be able to combine those into one loan for the agencies. As far as that applies to Fannie Mae. As far as CMBS is it's a roll of the dice, I would say, because it's a really wild market out there in the B market of the CMBS world, with them being very hungry for mobile home parks, but also being hungry for larger loans and not so much the smaller ones anymore. But that leads them to make exceptions and get a lot of these really large portfolios done, even if there is no anchor and even crossing the entire United States. So, for example, we're doing a CMBS refi now for a client. It is 37 parks. There is not one park over 50 pads, and it crosses over 18 or 19 states. So it's a pretty spread out portfolio. It's going to be a very large loan because of just how many pads in total there are. But CMBS can definitely be a very good option for those crossed loans, crossing parks into one loan.
Great. Thank you, Judah. And then the last question is, what if a park has some RV, say half MH and half RV? Can you get agency or CMBS debt on those types of parks?
CMBS, yes. Agency, no. Agency's cutoff is 20% for RV. They have made exceptions to go above that to if it's a park that has like really long-term, nice RVs that almost look like park models. They've made exceptions on those to go above the 20%, I think even up to like 35%. But otherwise, it's a no-go with agencies. And then something to just take into account with the agencies as far as an underwriting factor is when you have a park that has a mix in there of RV, so they're not going to just take your rent roll and let's say you have a fully occupied park and just take a 5% vacancy. They'll take the rent roll of the MH and then need a separate line item in your T12 or in your financials showing what the RV income was, and then they slap that income with a 10% vacancy. So it just hits your cash flow, obviously. That's within the agency world. CMBS is doing deals today that are fully RV, as long as they're really nice parks and long-term tenants. They're selective, but they've been doing that. We've been doing a couple with CMBS that are fully, full RV, so they definitely can get comfortable with a park that's even 50-50 or maybe even majority RV.
Great. I think those are all the questions from Eric. If you have any follow-ups, just throw them in the question and answer, and we'll ask them. I don't see any other questions coming in, so I'll ask a few, and maybe we'll stimulate some chatter in here. So something we get asked a lot is related to cap rates versus interest rates. So like when you have a 7.5% interest rate, how are you going to buy a 6 cap or a 3.5 cap, as you mentioned? And I'd like your take on that for, just all of our edifications, like how people make that math work.
I wish I knew.
Yeah, I know. Me too.
I think that people make it work with a variety of ways. One is obviously the most obvious. They have a 1031. They have a large influx of equity coming from an investor that has a 1031, a private family member that might have some extra money, a friend of theirs that won the Mega Millions. People that are cash heavy will be able to make a deal work that, they don't need to make so much money on their money, and they're happy with lower returns, which is automatically going to be there if you're buying an inverted deal, which is, your cap rate's inverted from your interest rate. That's obviously the number one way. But outside of that, there are people that get creative with seller seconds. So, and we're talking about a full seller second, right? So you go to a seller doesn't have any sort of debt cover ratios that he looks at. He knows that he wants $5 million for his park, and he knows that you can only buy it if he gives you a $4 million note. So his interest rate might be 6%, and you're buying the park for 4%. So the park is not necessarily affording that interest rate, but there might be a plan out of the gate to do a rent increase or to do some infill. So it justifies it on an underwriting, in your personal underwriting, and that the seller doesn't have any sort of underwriting. And then moving along, there can be a combination of, like we discussed, of senior loan and seller notes, either with banks that don't care at all and don't take that into calculation and are chilled with you guys just taking higher leverage that the property might not support, but you might have some seller second that there's no payments due for the first 2 years and payments are deferred. So there's different ways to structure that with, again, lenders that are totally okay with seller seconds, or with seller seconds that are on homes, or seller seconds that are, not disclosed to the bank, which again was not recommended, but they're, to answer the question of how we see some people doing that might be the answer. Outside of that, the numbers just, there's no real way to manipulate the numbers when you're buying an actual in place 5 cap, which is fairly common. Putting aside all the jokes about buying a 3 cap, if you're buying today a 6 cap with real upside, an in place 6 cap, lot rents are $275 and market rent is $750. We know that those deals exist. So there's so much meat on the bone that it makes sense for me to buy this at a 6 cap. But at the end of the day, my interest rate is 7.5%. So you're going to have to figure out a way to get those deals done in today's environment. And that can be a combination of, finding the last person that won the mega millions, or getting some sort of seller second creativity.
Gotcha. And then a follow-up question to that is, do you see a lot of buyers using rates as leverage to get higher cap rates from their sellers? And, does that happen often, given, where we're at with rates right now? I've tried that before and I think it's worked. I'd like your take on
Definitely
whether or
works.
not we see it. Yeah. Okay.
Yeah, it works, and it's a real argument. Obviously, it might not work for the real mom and pop seller out in middle of Midwest America that doesn't really know how interest rates affect you or him. So that's a tougher way to try to explain it to him. But it's definitely, with slightly sophisticated sellers or very sophisticated sellers, it's not only a conversation; it's a conversation that carries real weight. We all know where we're at, and I've had, even on the really sophisticated sellers and buyers, where they've structured it into the purchase and sales agreement. So they have in there, the purchase price for the park is $10 million, but that's with the U.S. Treasury sitting at 4%. If the U.S. Treasury goes up every 10 basis points that it goes up, my purchase price goes down incrementally by $50,000. And then it's in favor of the seller too. If it goes down every 10 basis points incrementally, my purchase price will go up, because all I need to do for my investors, and not only for my investors, to make my cash on cash work, is know that I'm getting a 70 or 75% loan to value loan. And right now, based on where interest rates are, this is what I can afford to pay. So if interest rates go up, I'm only able to afford to pay less. So on the really sophisticated sellers and buyers, we're seeing that input into actual purchase and sales agreements.
Awesome. And I guess a follow-up to that would be, do you think it's almost better to buy now because prices will be lower than when we see rates start to go down? Like, getting creative now could be very beneficial in the future. If you're able to close deals at these higher cap rates, and then you have the cost of debt going down pretty substantially, let's call it over the next 2 years.
Yeah, no question. If you're able to get a deal done in today's environment, you will be a very happy person in a year or two when ultimately rates do come down a little bit or cap rates continue to compress. Because right now, even if cap rates haven't gone up, right? But one thing that they definitely did do was reverse course or stop the course, right? So we might not have reversed it enough. Cap rates haven't gone up enough, but they've definitely gone up, right? There were deals trading on average across the U.S. taking into account all different types of parks. But I think on average in 2022, parks are trading on average at a 4.8 cap. So that's taking into account parks that were trading still then at 7 caps and some that were trading literally at 2.5 or 3 caps. And in 2024, and we're already into 2025, but in 2024, that was all the way up to 5.7. So cap rates might not have gone up as much as we need them to because of where rates have gone up to, but we definitely reversed course. And at some point, it's going to start going back down and start compressing again, whether it's slightly or even if it's not that much. But that together with interest rates coming down, if you can figure out a way to get a deal done today, and especially if it's a deal that has meat on the bone, you'll be in a very good spot in a couple of years.
Get those deals done, guys. All right, Saeed, you had another extra question here. Go ahead.
Yeah, you kind of touched on this earlier. I just obviously with all the tariff, inflationary, people say tariffs feed into inflation, right? What's your view on interest rates in the next, let's say next 6 months and then versus 1 and 2 years? Kind of feeding into that, piggybacking off that conversation you were just talking about.
Yeah. So I told Michael, for me to give away my crystal ball, then I would have to charge a lot more. And if you guys pay for the premium membership, it's really hard for me to opine on what I think, because I would have never dreamt 2 days ago that interest rates can go on such a seesaw. I think we also are dealing with an administration that, as much as I'm personally a Trump fan, I don't know, it's not a political type of webinar here. I personally am a fan of the man, but he's, for lack of a better word, unhinged. So he can literally say something one day that will send everything into a complete tailspin, even if it's just him being him or him trying to get something done. But in the interim, it can cause what we saw in the stock market and what we saw in treasury bonds and the flight to safety. So I think we're in a period of time where it's so much economic uncertainty together, coupled with the fact that we do have an administration that is not your typical administration, where you can kind of hope that if they do X, Y, and Z, then things will follow a certain trend. I think that we're, in a spot where it's a little bit too tough to tell, because there's, like, as you see, right, throwing tariffs against the whole world can at least in the short term send things into a complete tailspin. And so my personal opinion is that we're in a time now that is still historically, in past 50 years, still historically really low rates. So I know we got used to even lower rates, but I think that we have to look at what we have right now, and what we have right now is okay. I mean, it's not okay because of cap rates not expanding enough, and obviously so many other factors going on. But I think that's kind of the long and short of my long-winded answer.
Saeed, any follow-ups? I think you're muted, but I'm gonna move. Oh, go ahead.
No, that was helpful. Thank you.
Sure.
And then one final question from Eric, and then I'll let you talk about your practice here, Judah, and let people know how to reach out to you. But Eric's last question here is: best ways to get non-recourse on smaller loans under 1 million?
The non-recourse loans under 1 million are going to be very, very tough. You might be able to get that with some of the lenders that are typically larger banks that want to see larger loans, but this is an exception where you'll take 60% leverage. So you're buying the park for $2.5 million and you're only taking $1 million loan or sub-$1 million loan. I haven't had much success if any, outside of a few rare exceptions from the agencies, which were made for really large borrowers of theirs. So Godspeed by all of you very, very soon. Once you're a larger borrower of the agencies, so it's kind of like any other bank, right? You're buying a park that is not really within their box, but they'll make an exception for you because they want to keep that relationship going. Outside of that, I haven't seen any non-recourse at that level.
Great, thank you. All right, so I'll hand it off to you, Judah. Why don't you tell people how to reach out to you and when to reach out to you?
Sure. So how to reach out to me is any sort of contact information that you can post for everyone, which is easiest and obviously most efficient, is texting me. I won't typically pick up a call that I don't know who's calling me unless it's a scheduled call and I know that like kind of within the email invite. But otherwise, just text me, hey, it's so and so, part of Mike's group, and just had a quick question. When's a good time to call? That's the easiest. Reach out to me on Instagram, Facebook. You can email me, judah@princetoncapgrp.com. The time to reach out to me is a really good question and an important one, because a lot of people are like, no, I don't want to spin your wheels. I'm just, kind of looking at this deal and it's interesting to me, but let me first get it under contract and then I'll call you. I would love that in a way, because then I know that a deal is real when you're sending it to me, it's under contract already. But a lot of times you're dealing with sellers that are only giving you a certain amount of time to get that deal closed. So if you're going to only reach out to me and first familiarize me with the deal, once you have it under contract, I'm running behind the 8 ball. And then by the time I get it out to lenders, get back lender quotes, pick a horse to race with, you're already 30 days into your due diligence, and then tell me, hey, Judah, we have 45 days to close. So I would rather get involved earlier than later. But I would also say, if it's just picking my brain, just text me. If it's a deal that you want me to take a serious dive into because you want to get, some sort of soft feedback on where terms would be, then on any deal that you're looking at seriously, that you feel like you're close to an agreement on purchase price, and the broker tells you, this is a deal you can get for $3 million, and in your model that you put together, it almost makes sense, or you're at 2.9 or 2.8, and you just want to know, am I underwriting this correctly? Am I using the correct financing assumptions? At that point, I'm happy to spend the time. This is a relationship business. I'm not only here for the deals that you get under contract and close. I'm here to be another source of underwriting for you, and to be able to assist you in getting deals under contract by showing you what the most aggressive debt is out there. So feel free to reach out. We have a nice team here that works alongside me, makes my life a little bit easier, and I appreciate the opportunity.
Absolutely. And I can attest again to the quality of Judah's team. They are very easy to work with and good at educating as well. So definitely reach out after this call. You guys should see a follow-up email. There'll be a form in there. If you want to click that, it'll connect you directly with Judah via me and Ryan, so that there's a little bit more of a personal connection there. And then, you can grab Judah's contact information through that. Otherwise, if there's no other questions, we got 3 minutes left, so I'll close it there. Feel free to answer those or ask those additional questions in the mastermind, and I'll make sure to forward those along to Judah so that he can answer them in his free time. But really appreciate everyone joining today. Really appreciate your time, Judah. Thanks for doing this after a long trip to San Diego. I know it's not easy, so I appreciate it.
On the weekend.
Have a good one, everyone.